Hi, this is Zak Mir with the Bulletin Board Heroes here at Vox Markets for Monday, the 17th of January. Starting off with 88 Energy, which looks like it's making progress after that trend line break from September. That was around the 1.5 pence level, and we bounced off that line and also pushing above the 200-day moving average at 1.6 pence. Uptrend line in the RSI window, so it's a bullish divergence line. That should ensure that we not only break the initial January peak around £1, 1.85 pence, but also then go on to retest the July-August resistance area towards 3 pence over the next 4 to 6 weeks. Stop loss back below 1.5 pence. One of the stocks which has been perhaps the easiest ride in its short lifetime on the stock market is Ben's Creek. And positive news today regarding production, etc. And here we have a gap higher through or off the floor of this rising trend channel from back in October. I suppose you could say that there's a line of resistance there as well, which it's gapped through. That's from the beginning of December, and above that, around 34 pence, looking for a 55 pence target at the top of the November rising trend channel. That could be hit as soon as the end of next month. Moving along to a stock which highlights how the oilers have revived in the recent past. We've got Chariot Oil and Gas, which is, I suppose, doing Canadian overseas at the moment. The gap higher, unfilled gap to the upside, and pushing on from that. Minimum here likely to be the top of the March rising trend channel from last year at 14.25 pence, maybe by the end of this month, and almost certainly before the end of next month. If you're looking for a stop loss back below that last floor there, around 10.6 pence, last swing low, should do the trick. And as I said, we're looking for much more given the way that we've had an island reversal. So gap down in May and gap up in January. Doesn't get much stronger than that. Shows a significant re-rate could be on the cards over and above what we've already got. And speaking of copper, here we've got Canadian overseas. The gap to the upside, unfilled gap to the upside, breaking that line of resistance from August finally after clearing out, I suppose, the last of the weak hands down below 20 pence. Current situation is that while we're above the 200-day moving average at 33 pence, looking for as high as 50 pence, perhaps as soon as the end of next month, or even as soon as the end of this month. If it was anything other than Canadian, one would probably say it would be by the end of this month. On to DeepVerge, which had a bit of a knock towards the 20 pence level, but that was basically, it looks like an exhaustion gap there to the downside. And we closed above that gap back on the 12th of January. So that was a technical buy signal, a gap close buy signal. And we progressed very well since then. We would expect the shares to hit that line of resistance from May at 31 pence as a minimum. And obviously after that, then we can see whether the shares can head back into the 40s, which is where they were back in March. At this stage, only really back below that last December low there, around 26 pence, really delaying the upside scenario. Interesting to see how Helium One managed to revive itself even ahead of today's news, which was quite a result. So we've had what's the third day of revival, and the news coming out today. We were looking for a break of 8 pence, giving us 12 pence, and we're not too far away from that. And I suppose with the news today, we could probably hit 13 or 14 pence at the 200-day moving average. If you're a fan of the shares, I suppose the top of that channel is actually up to 20 pence. Let's see if we can get that over the next month or two. But 14 pence, the initial target, while we're above 8. Had a request for i3 Energy, which has been consolidating of late. I think one can say nice pattern here on the daily charts of breaking that line of resistance from back in July, and now just starting to break post-September resistance at 14 pence or 14.25 pence. Decent weekly close above 14, and we should finally get onto a decent push to the upside. Upside here up towards 28 pence, which is that January 2021 resistance line projection, but at least a retest of the best levels of the past year at 16.5 looks to be on the cards, even if we don't get up to 28 pence too soon. Stop loss at the moment back below the 50-day moving average at 12, so above 12 looking for 16 and then 28. Good news today from Poolbeg, and Looks like this could be the news that gets the shares going. We've got that resistance. Well, we've had basically a triple bottom here for the shares just below 8.5 pence. That should be enough to get them off the ground on a sustained rally. If you're cautious, maybe wait for an end of day close through 9.75, which is today's high. After that, we're up to 12 or 13 again, which is the best levels that we've had since the shares came to market. The positive here, though, is again that we've got this uptrend line, bullish divergence line in the RSI window, which should keep the shares on a recovery track. Onto a stock which one or two clever people on Twitter flagged last week, and here we go with Serinus breaking that line of resistance in the 50-day moving average at 1.75. Above that, looking for 2.8, 2.9 at the top of that broadening August triangle that's been in place since the summer. The other positive here is the again a bullish divergence line in the RSI window. That should allow the shares or lead the shares higher to that 2.8 pence zone target, maybe as soon as the end of next month. Overall, a double bear trap below August support at 1.75 pence. So that's really the area that we need to maintain ahead of a push to the upside. A lot of people like technology minerals, TM1, and looks like the shares are finally starting to show that they've got their analysis in the right place. Initial target here was up to the 5.25 pence level, the top of that rising trend channel from November. Also, we've got the situation here where the shares have managed to close or will close above the initial peak there, the November peak at 4.25. So it's an opening range break above 4.25. We're looking for the 5.5 pence level initially, and then up to as high as 7.5 or 8 pence over the following 1 month or so. So looking pretty well set up for TM1 at the moment. This stage only really back below 4 pence, questioning the breakout scenario. Couple of novelty stocks to go for to finish off versus Tyndar, which is obviously headed for the stars. I came up some levels, sort of 160 and then 260 and then 350, and I suppose we've done all those. What will be interesting now is to see whether the shares can hold 260 and then head up to the maximum level, which at the moment looks like £5, maybe over the next month, but clearly they've done a lot of work in a short time. So the key here, though, is to hold that 250, 260 zone to give the shares a chance of heading up to £5, maybe over the next month after a consolidation. Finishing off with another stock which has been off to the races, T42. And here we've got this 3 steps forward, 2 steps back type of progression. Looking quite healthy, looking healthy enough for a move towards the resistance line from the early part of last year at 34 pence. We could see that maybe over the next 2 to 4 weeks. And with upside valid while we hold above the old December peak at 21 pence, above 21, looking for 34 on T42. That's it from me today. More updates tomorrow.